Create a YouTube 16:9 video using this script. Table of contents, about 9 sections. 1. Your 8,046 is waiting. How families can claim it. 2. Understanding the Earned Income Tax Credit, EITC. 3. Unlocking the Child Tax Credit, CTC. 4. The paper trail. Documents you absolutely need. 5. Your step-by-step guide to filing and claiming your money. 6. A real-world example. Meet the Garcia family. 7. Watch out for these common filing mistakes. 8. When to file and where to find free help. 9. Your next steps to claim your money today. Written by John Chatsky. Her Money, NBC Today. Your $8,046 is waiting. In this video, we're going to show you exactly how families can claim it. It's a figure that could be life-changing for so many, yet it often goes unclaimed. Why? Because the system can feel complicated, and many people simply don't know this money is available to them. Did you know that thousands upon thousands of hardworking families leave a staggering amount of money on the table every single year? We're talking about billions of dollars in total, just sitting with the government, waiting to be claimed by the people who earned it. It is absolutely true. And let me be perfectly clear about what this is and what it isn't. This is not some contest, a sweepstakes entry, or a once-in-a-lifetime lottery win. There's no luck involved here. This is real money that you have already earned through your hard work, and that you are legally entitled to receive. It's a refund from the government, specifically designed to put more money back into the pockets of working Americans. Right now, as of today, February 8th, 2026, the tax season is in full swing. And based on the current tax laws, there is a potential $8,046 waiting for a family just like yours to claim. Now, it's crucial to understand that this specific number is an example. It represents a potential maximum for a family with a certain income and number of children. Your actual amount could be more or less, depending on your unique situation. Think about a single parent, let's call her Sarah, working as a home health aide and raising 2 young kids. She files as head of household and makes around $28,000 a year. For her, qualifying for both the Earned Income Tax Credit and the Child Tax Credit could mean a refund of several $1,000s. That's not just a little extra cash. That's the money she needs to finally replace the bald tires on her car, pay for a summer camp for her kids, or build up an emergency fund. It's a lifeline. Or consider the Jacksons, a married couple with 3 children. He works in construction, and she has a part-time job and does some freelance graphic design on the side. Their combined income is about $62,000. They might assume they earn too much to qualify for significant help, but with 3 kids, they could still be eligible for a substantial portion of the Child Tax Credit and potentially a smaller amount from the Earned Income Tax Credit. This could be the difference between struggling to pay for braces and being able to afford them comfortably. This is not a gimmick or a trick. These aren't loopholes for the wealthy. It is a completely legal and frankly encouraged way to boost your family's finances through official IRS tax credits. These programs were passed by Congress with the specific goal of reducing poverty and supporting the financial stability of working families. The government you to claim this money. And the best part? You do not have to be a tax expert, an accountant, or a financial wizard to get this money. You don't need to spend hours deciphering dense legal documents. You just have to know that these credits exist and how to ask for them when you file your taxes. That's the key. Awareness and action. And that's exactly why I've made this guide for you. I know that when you look at all the paperwork, the process might sound complicated, even intimidating. The tax code is notoriously complex, and it's easy to feel overwhelmed and worry about making a mistake. But I promise you, it is so much simpler than you think, especially with the tools available today. We're going to cut through all the noise and confusion. We are going to break it all down, step by step, in plain English. No jargon, no confusing terminology. I will show you exactly what to do, what information you need to gather, and where to put it when you file. This money we're talking about, this potential $8,046, primarily comes from 2 powerful refundable tax credit programs designed specifically for working families. First, the Earned Income Tax Credit, or EITC, and second, the Child Tax Credit, or CTC. Together, they form the backbone of financial support for millions. In the next sections, we'll dive deep into each one so you can walk away from this video feeling confident and ready to claim every single dollar your family deserves. All right, let's dive deep into the first major component of maximizing your tax refund: understanding the Earned Income Tax Credit, or EITC. Think of it as the tax code's way of giving a financial boost to hardworking individuals and families across the country. So, let's talk about the first big piece of this puzzle, the EITC. At its core, this credit is designed to help working people with low to moderate incomes. It's not a handout, it's a reward for the work you do all year long. The primary benefit is twofold. First, it directly reduces the amount of tax you owe, which can be a huge relief. But here's the most powerful part. It's a refundable credit. This means even if the credit is more than the tax you owe, or even if you owe zero income tax, you don't just get your tax liability wiped out. You get the remaining amount back as a direct payment. That's what refundable means. Actual cash back in your pocket, which can make a significant difference for your budget. Now, how does the EITC amount get calculated? It follows a three-part structure: a phase-in, a plateau, and a phase-out. As you start earning income, the credit amount increases. That's the phase-in. It continues to rise until your income reaches a certain level, where the credit hits its maximum amount. This is the plateau. After that point, as your income continues to increase, the credit amount gradually decreases until it reaches zero. This is the phase-out. The specific income levels for these stages depend on your filing status, like single, head of household, or married filing jointly, and the number of qualifying children you have. So, who is eligible? The first rule is right in the name. You must have. This means money you received from working for someone else, which appears on a W-2 form, or from being self-employed, which you'd report from a 1099 NEC or other business records. It's crucial to know that certain types of income do not count. Money from investments like stock dividends or capital gains does not qualify as earned income for the EITC. In fact, there's a limit on how much investment income you can have and still claim the credit. For tax year 2025, this limit is set at $11,000. If your investment income exceeds this, you're ineligible for the EITC, regardless of your earned income. What if you don't have qualifying children? You can still claim the EITC, but there are specific age rules. You must be at least 25 years old but under 65 at the end of the tax year. This rule ensures the credit supports a broad range of working adults. If you do have children, they must pass 4 specific tests to be considered a qualifying child for the EITC. First is the relationship test. The child must be your son, daughter, stepchild, foster child, sibling, or a descendant of any of them. Second, the age test. The child must be under 19, or under 24 if they're a full-time student, or any age if they are permanently and totally disabled. Third, the residency test. The child must have lived with you in the United States for more than half the year. And finally, the joint return test. The child cannot have filed a joint return with their spouse for the tax year, unless it was only to claim a refund. A critical requirement for everyone is having a valid Social Security number. You, your spouse if you're filing jointly, and any qualifying child you claim must all have Social Security numbers that are valid for employment. There are also a few key disqualifiers to be aware of. You generally cannot claim the EITC if your filing status is married filing separately. Also, you must be a U.S. citizen or a resident alien for the entire year. If you were a non-resident alien for any part of the year, you're typically not eligible. Now, let's talk numbers. For tax year 2025, which you'll file in early 2026, the amounts can be substantial. The income limits and credit amounts change every year to adjust for inflation, so it's always important to check the latest figures from the IRS. For example, a married couple filing jointly with 3 or more qualifying children could potentially receive a credit of over $7,000. For a head of household with 1 child, the credit could be in the thousands as well. These are just examples, but they illustrate how impactful this credit can be. And here's another layer of benefit. Many states, and even some local governments, offer their own earned income tax credits. These are often based on the federal EITC, so if you qualify for the federal credit, you may automatically qualify for a state one too. This could add hundreds or even thousands more to your total refund. Be sure to check your state's Department of Revenue website to see if this is available where you live. Finally, and this is the most important action item, you must file a federal tax return to claim the EITC. It is not automatic. Even if you don't owe any tax and aren't normally required to file, you have to file a return to get this money. Don't leave it on the table. Unlocking the Child Tax Credit, CTC. It helps families with the costs of raising children. Diapers, food, clothes, school supplies, costs add up fast. The credit provides direct relief to millions of parents. The child you claim must be your dependent and under 17 at year-end, with a valid Social Security number. Your income must be under thresholds. Amounts phase out as income rises. A portion is refundable. The additional child tax credit can add cash to your refund. Combined with EITC, totals can climb quickly, up to that 8,046 figure for some families. Amounts can change year to year. Check the rules for your filing year. More qualifying children can multiply the benefit, providing even more support. Before you file, do a little homework. Gather the necessary documents. Think of it like lining up ingredients. Prep makes everything easier. A little prep now saves headaches later. First, Social Security numbers for you, your spouse, and every dependent. Typos here delay refunds, double check and triple check. Have exact birth dates for everyone on the return. Gather W-2s from each employer. If self-employed, 1099, NEC, or 1099K, and include every short-term job. Report all earned income to calculate credits accurately. Keep childcare receipts plus provider name, address, and tax ID. Keep proof of your child's residency. Have your bank routing and account numbers. Direct deposit is fastest and safest. Organization is your filing superpower. Now that your documents are ready, it is time to file and claim your credits. You have several great options, many free. IRS Free File if under the income limit. Or use reputable tax software that asks simple questions and finds credits. Enter your personal info carefully. Name, address, Social Security number. Enter every W-2 and 1099 exactly as shown. Add dependents and answer age, relationship, and lived with questions. Take your time. Accuracy is key. The software does the heavy lifting, calculating EITC and CTC and how they grow your refund. Watch your refund update as credits apply. Review names, social numbers, and bank numbers. Fix any typos. E-file and choose direct deposit for a quick, secure refund. That is it. You have successfully claimed your money. To truly understand the power of these credits, let's walk through a detailed, real-world example. We'll see how the Earned Income Tax Credit and the Child Tax Credit can combine to create a substantial refund. For this illustration, we'll meet the Garcia family. We're going to calculate their potential refund based on their specific situation, and then explore a few what-if scenarios to see how small changes can impact the final numbers. Remember, these figures are for educational purposes, and your own situation will be unique. This is Maria. She's a dedicated certified nursing assistant, working long hours to care for others in her community. Her job is demanding, but it provides a steady income for her family. And this is her husband, David. He works at a local home improvement warehouse, helping customers and managing inventory. Together, their hard work forms the financial foundation for their household. They have two wonderful children, Sophia, who is 8 years old, and her younger brother, Leo, who is 5. Both children are U.S. citizens with valid Social Security numbers and live with Maria and David for the entire year, making them qualifying children for tax purposes. For the 2025 tax year, Maria and David decide to file their taxes together using the married filing jointly status. They've gathered all their W-2s and calculated their combined earned income, which comes to exactly $45,000. They have no other significant income sources. Based on their joint income of $45,000 and having 2 qualifying children, they fall squarely into the eligibility range for the Earned Income Tax Credit. The tax software calculates their EITC, and they qualify for approximately $3,000. This is a fully refundable credit, meaning it can reduce their tax liability to zero, and the rest comes back to them as a refund. Next, we look at the child tax credit. For this example, the maximum credit is $2,523 per child. Since both Sophia and Leo qualify, the Garcias are eligible for a total CTC of $5,046. This credit is also partially refundable, which is a huge benefit for them. Now, let's do the math. We add their $3,000 EITC to their $5,046 CTC. The sum is a staggering $8,046. This amount is added directly to their tax refund, transforming a small return, or even a tax bill, into a significant financial windfall. But what if their income was slightly higher? Let's say David worked some overtime, and their combined income was $50,000 instead of $45,000. Because both the EITC and CTC have income phase-outs, their total credit amount would decrease. Their EITC would be lower, and their CTC might also be reduced, resulting in a smaller, though still substantial, total refund. This shows how sensitive these credits are to your exact income level. Here's another scenario. What if only one of their children, say Leo, was a qualifying child for the year? Perhaps Sophia had lived with another relative for more than half the year. In this case, they would only claim one child for both credits. Their EITC would drop significantly because it's tiered by the number of children, and their CTC would be cut in half. The final refund would be thousands of dollars less, highlighting the importance of each qualifying dependent. For the Garcias, this $8,000 refund is life-changing. It's not just a number on a screen. It's a tool. It can be used to pay down high-interest credit card debt, finally establish a robust emergency fund for unexpected car repairs or medical bills, or even be saved for a down payment on a future home. This is the real-world impact of correctly claiming your tax credits. Now that you see what's possible, it's crucial to understand that simple mistakes can cause major delays or even lead to the denial of these credits. Let's cover the most common errors so you can avoid them and ensure your filing process is smooth and successful. The single most common error is an incorrect Social Security number for yourself, your spouse, or your dependents. A single mistyped digit will cause the IRS system to reject the claim for that person. The best practice is to double-check every number against the physical cards. Then, read each number aloud as you enter it. It's a simple step that can save you months of headaches. Another frequent mistake is choosing the wrong filing status. This is especially common for single parents who may incorrectly file as single when they actually qualify for the more advantageous head of household status. To qualify as head of household, you must be unmarried, pay for more than half of the household expenses, and have a qualifying child or dependent live with you for more than half the year. Getting this right can significantly change your tax outcome. Remember, only one person can claim a child as a dependent. If a child's parents are divorced or separated, this can lead to both trying to claim the same child, which automatically triggers an IRS review. The IRS has specific tiebreaker rules to determine who has the right to claim the child, which usually defaults to the parent with whom the child lived for the most nights during the year. It's essential to coordinate with the other parent to avoid this conflict. You must report all of your earned income. The IRS receives copies of your W-2s and 1099s directly from your employers and clients. If the income you report on your tax return doesn't match what the IRS has on file, their automated system will flag your return for review. This includes income from side gigs, freelance work, or any job where you received a 1099 NEC. Forgetting even one small income source can halt your entire refund. Finally, a simple but devastating error is incorrect bank account information for direct deposit. If you mistype your routing or account number, your refund can be delayed for weeks or even months. It might be sent to the wrong account, or if the account doesn't exist, the IRS will have to mail you a paper check, which takes much longer. Triple-check these numbers before you submit. The key takeaway is this: be honest, be accurate, and be thorough. Taking an extra hour to carefully review every detail on your tax return is the best investment you can make to ensure your refund arrives quickly and without any issues. Tax season usually starts in late January. File as soon as your W-2s and documents arrive. Filing early speeds refunds and reduces ID theft risk. Aim to file well before April 15th. Most e-filed direct deposits arrive in under 21 days. By law, refunds with EITC or additional CTC cannot be issued before mid-February. If claiming these, expect late February or early March. Feeling overwhelmed? Help is available, free. Volunteer income tax assistance sites offer free, high-quality prep. IRS-certified volunteers help those earning about $64,000 or less, persons with disabilities, and limited English speakers. Use irs.gov and the EITC assistant to check eligibility. Many providers offer free versions for simple returns and robust FAQs. Do not hesitate to seek help. It ensures you claim every dollar you deserve. Accurate filing plus the right support gets your refund in smoothly. There is potentially thousands in legal refund money waiting for you. For the right family, 8,046 is real. These credits are designed to support hardworking families. You are not asking for a handout, you are claiming what you earned. Do not let this opportunity pass you by. You know the process is manageable, and help exists if you need it. Start a folder labeled Taxes 2025. As W-2s and 1099s arrive by mail or email, file them immediately. Use the EITC assistant in minutes. See if you are eligible. Search for a local Vita site for free, in-person help. This is your money. Pay bills, save for the future, breathe easier. Make a simple plan to file. Gather documents, check eligibility, set your filing date. Do not leave money on the table. Go claim the 8,046 that could be yours. You can do this. Maximize your tax refunds with these tricks. File early. Use Free File or Vita. Double-check social numbers. Choose direct deposit. Subscribe for more money smart guides and share this to help another family claim what they deserve.